So we are going to cover public issues. Okay. Why we are covering it? Because whenever there's an IPO or an FPO, so we see the price band. We have to make a decision whether we should go for it or not. So basically, it's a valuation that we want to understand whether the company has priced the share correctly or not. So there will be a case study in your exam which you have to resolve. So that's why we are covering this. Okay. So public issue. So it's a good knowledge also for you, all of you, because this is a very prime this thing. Okay. So, actually, I have revised the PPT, but I think I have given you the older one. But anyway, no issues. हाँ रिवाइज है नहीं वो रिवाइज है उसके बाद भी एक सेकंड रिवीजन हो चुका है. So I'm just going to open that. Okay, that will be better. So classification of issues. So whenever a company comes for a public issue, whether it's coming for an IPO, that is the first time when a company comes and issue shares to the public, and in the process it gets listed on the stock exchange. It's called an IPO. Or the company can issue an FPO, which is called further public offering, where this is subsequently the company wants more money, so they can issue shares. Or it can be a rights issue, where the shares are offered to the existing shareholders. Okay. Now the first right belongs to the existing shareholders. Okay. Suppose the company needs money and existing shareholders are not willing to contribute, then the company has to pass a special resolution in the Company Act, and they have to call a meeting, and under a special resolution, the shareholders permit the company to go ahead and come with an FPO. Okay, so it can be a right issue, it can be a IPO, it can be a FPO. Okay, now there can be some further things also. It can be a private placement, it can be a QIB placement. That means you issue shares to only select few instead of going to the public. Selected few people. It's called a private placement. Okay, so there are various ways through which company can raise money. What happened? अब आएगा आएगा अपने बजट. So issues can be public, rights, and preferential. Okay, fine. So it can be an IPO, it can be FPO. Okay. Now within IPO, it can be fresh issue or it can be offer for sale. Similarly, FPO, it can be fresh issue and it can be offer for sale. So have you heard this offer for sale? OFS? Who has heard? Okay. Now what is OFS? No, no. Okay, okay. Let me just tell you. It's a part of IPO or FPO as it is mentioned here. So basically, when the existing shareholders, the promoters, they are offloading the shares. For example, let's talk about a company called, LIC or IRCTC. They are all owned by government. Okay. So they wanted to sell their own shares to the public. Okay. So this was called a disinvestment process of the government where they want to bring down their shareholding. So they offered their own shares to the public through a process called IPO. So whatever money the company got, it went to the government. It never went to the company. So company was not using that money for expansion. Similarly, companies, the promoters, when there is a startup and the company grows, so promoters can offload their shares to some extent. Suppose the promoter is holding 70% shares, so he'll say, okay, I can offload 20%. Okay, still I remain the largest shareholder, so he can offer his own shares to the public, so that the money which is collected through this process goes to the promoter's pocket and doesn't go to the company. Okay, if it is a fresh issue, that means the money will go to the company and company will use it for the objects for which the public issue was announced. For example, paying loans or buying, expanding the footprint of the company. Okay, so it can be for expanding the company. Okay, now these are the regulators basically. SEBI, who regulates the public issue in India, the SEBI, Companies Act 2013, stock exchanges, which means National Stock Exchange and Bombay Stock Exchange, and RBI, Reserve Bank of India. So these are the regulatory bodies basically which involved in framing some rules and regulation with respect to the public issues. Now, what are the key regulations? Of course, the regulation which we are going to talk about is called the ICDR, which is mentioned in the second box. The SEBI issue and capital and disclosures requirement. Okay, and it's called Regulations 218. 2018. It was issued and amended in 2018. Of course, then there are, LODR, which is the listing obligation and disclosure requirement, 2015. This is the listing regulation. So because the stocks are getting listed on the stock exchange, so there are some regulations which the companies need to follow. Okay. Then the Companies Act, 2013. So we are going to focus mainly on the ICDR, which is called Issue of Capital and Disclosure Requirement, issued by SEBI. Okay. Now this piece of law gets keep on getting amended from year to year. Okay. So what are the types of issues? Okay. What are the various kinds of issues? IPO, FPO. And then we talk about eligibility requirement of an IPO. Who can come and issue shares to the public? So there is some eligibility criteria. So we are going to focus on eligibility. So the questions will be on eligibility also. Then eligibility requirement of FPO. If you're coming for an FPO, what is the requirement of the SEBI? Then additional requirements for offer for sale and issue of warrants, filing of offer document. Okay. So then of course this covers all the bullet points which we are going to cover. Okay, so the company needs to come up with an offer document, which is ultimately called the prospectus of the company. Okay, so it makes a draft offer. Okay, giving the details of the company and the details of the offer made to the public. Okay, along with a lot of other information, and files it with SEBI and seeks their approval. Okay, and offer also publishes in the public domain so that it invites comments from the public also. Okay. Then, there is a process called ASBA. Now we have UPI. So how do the companies collect money? In earlier days, company used to collect the money by checks. So we used to, make a check payment for an IPO whenever we are applying. So if we are successful, we'll get the shares. If we don't get the successful, we'll get our money refund back. So crores of people are applying for and issuing checks. So this process was very cumbersome. Sometimes I have issued a check. I was not allotted shares. I never got my money back. So I'll keep chasing with the company. So now because systems have changed, so we are more digitally better now. So now we have UPI payment or ASBA. ASBA is application supported by blocked amount. So here we give a mandate to the bank, block my amount, okay, to the extent of what I have applied to the company. And if I get shares, then that block money will be transferred to the company. Otherwise, the block will be removed. Suppose I'm not getting shares, so the money will remain in my bank account only. It will not move out till I get the shares. Okay, fine. It's called ASPA. And now UPI also, is doing the same thing. Here also your money get blocked through UPI. It's not that when you make a UPI, the payment goes to the company. The money will get blocked in your UPI or bank account, and then it will be transferred only when you get your shares. Otherwise, the UPI block will be removed if you are not successful. Okay. Opening of the issue, when the company needs to open the issue. So what is the regulations? After the SEBI has given the approval, okay, with regard to the offer document prospectus, they can raising the money from the public. What is the time frame? So within 10 days or up to maximum 1 year, they can come with an IPO after the offer document has been approved by SEBI. Then underwriting. The shares are underwritten by the merchant bankers. In case if there is lukewarm response from the public and the issue falls short, then the underwriters will absorb those shares. So when the shares are underwritten, the public has a confidence that shares are being underwritten by merchant bankers, okay, by various financial institutions. So they get this thing that then they apply, okay, because they know that somebody has underwritten it, okay. So they have a strength of under this thing. Minimum subscription. So suppose a company say goes for 1,000 crores public issue, at least 90% of the money should be collected. That means 900 crores should be collected. If not, then the money has to be refunded back to the shareholders, or then the company cannot take the money from the applicants. Oversubscription. Lots of time, the share goes oversubscribed 10 times, 100 times, 50 times. So can the company retain that money? No. Company has to return back the money. They can retain only 1% extra. And that is only to meet out when they allot the shares, The shares are, on a lot, there is a lot size. Every company gives a lot size. One lot is say 50 shares, or one lot is 150 shares, or 200 shares. So every company decides about the lot size. So in the process of issuing the shares, suppose they have to issue a little more to meet all the requirement. Maximum they can issue up to 1% more. Okay. Suppose the share, it was oversubscribed. Say 100 crores issue, they collected 200 crores, but they can keep only 1 crore extra just to meet the allotment process, to issue your shares, to facilitate the odd allotments and other things. They can keep 1% of money with them maximum, not more than that. And the purpose is to see that there is a fair and equitable allotment to the public based on the lot size given by the company. Then monitoring agency. So, if the company is above, say, maybe 100 crores, I'll just see the figure. If the company is coming up with an issue of more than 100 crores, then there is a monitoring agency which the company has to, engage. Who is going to monitor? Okay. And monitoring agencies, I think now it is done by all the credit rating agencies like ICRAS, or, huh? Yeah. So those companies are allowed to monitor. So they will, suppose the company has collected 1,000 crores, whether the money has been spent for the purpose for which the issue was there. So they are going to give a report to the company, and company is going to pass on the report to the shareholders. Okay, that all the money for which the company has raised the public issue, they have utilized for the purpose for which it was issued. Okay, so there is a monitoring agency which monitors your company whether you are spending the money at the right place. What you have said that you are going to use the money for paying loans. So have you paid loans or not? Or you're going to buy plant and machinery, you have bought it not. Then we have the allotment procedure and basis. So we are going to study that a little bit. Allotment refund. Suppose if the any refund has to be given. Okay. So what is the process? If the refund is not given, say within 4 days, then the company has to pay 15% rate of interest. Okay. Release of subscription money. That means all the money which has been collected through a public issue process, it will go to an escrow account of the company. Okay, till the company has done all the formalities and the merchant banker gives a green signal and says that company has met with all the requirements of SEBI, then the money will get transferred to the company's main account, and then they can spend the money. Otherwise, the company money will be remain in hold in a escrow account. Price and price band. So company decides about the price, at what price they are going to issue shares, or a price band. Sometimes the company will say, okay, we are going to issue shares between 100 to 120 rupees. So it's called the price band. And this price and price band are decided by the company along with merchant bankers. They are going to value the company. So we are going to talk about more about this. Okay, fine. And we are going to focus, and there will be a case study on that price and price band. So here, just to give an idea, the price band has to be, 100, 20% maximum, upper cap and lower cap. So there can be only difference of 20% between the upper cap and lower cap. If suppose the issue price is 200, the maximum price they can offer is 240. So they will invite bids from the public between 200 to 240. Okay. And the upper band cannot be lower than 5% or 105%, which means if the share price is 100, okay, then minimum 105. So 100 to 105 has to be there. Okay, they can't say 100 to 101. So 100 to 105 is a norm, but they can go up to 20%. Okay. Then promoters contribution. So promoters have to bring their own contribution. So promoters contribution, if you ask, this thing, what is a general this thing? 20% should be contributed by promoters, or that means promoters should have at least 20% of the stake in the company after the whole issue has been subscribed of the total capital of the company. Then minimum offer to public and reservation. Okay. So minimum offer to public is, public has to be given shares. Fine. And minimum offer to the public should be at least 25%. Okay. Fine. But again, there is, a law which says that, it can go up to say 5% depending upon what is the issue size. Okay. But normally 90% companies, if their issue capital is less than 1600 crores, then the minimum offer to the public should be 25%. Otherwise, company will not be listed in the stock exchange. And then reservation, of course, you can reserve the issue for employees, for other people. So we'll talk about that. Allocation in the net offer, exit opportunity, allocation in net offer. So this also we are going to understand detail when it comes to exit opportunity. Suppose if shareholders are not happy because the company has used the money for different purpose. Suppose their company there was no monitoring agency. Okay, company has used for for different purpose. Then the existing shareholders, they can, in a resolution passed, they can go against the company, and the company has to return the money back to the shareholders. If the company said that we are going to use the money for paying loans, but instead of paying loans, they have spent the money for doing something else. So there can be some dissenting shareholders. There should be an exit opportunity given to them if the shareholders feel their money has not been properly utilized. Then we have the rights issue, preferential issue, qualified institutional placement, SME exchange. Okay. Now, when you go to the, huh, see, whenever the companies are coming for a public issue, they can issue their shares on the main board or SME board, SME exchange. So national stock exchange is divided. There are various portions of stock exchange. One is called the main board, okay, where all the shares of the company, Reliance, everything when we buy in, which is called the main board, okay. So all the people, 99 people understand the stock exchange is only one, but there are various divisions. So there is called SME exchange. All the small companies, they can issue shares in the SME exchange segment of National Stock Exchange and Bombay Stock Exchange. Okay, if small companies, small and medium companies, they can go to the SME exchange and issue their shares from there. Okay, and they are also traded on the stock exchange, but it's a separate version of the stock exchange. हाँ, either it's a main board or SME board exchange. Okay, fine. So there are two different exchanges for them. अभी इतना ही समझ लो, अभी चलते हैं. Listing pursuant to IPO at IGP. Now there is Innovator Growth Platform, which is called IGP. So this is here another division of the stock exchange. Earlier, all startup companies were allowed to issue shares through IGP exchange. Okay. Anyway, this is going to just confuse you, but so there are couple of divisions of the stock exchange. One is called the main board, and mainly we refer to the main board, which is the main stock exchange. Then the stock exchange can be SME stock exchange, where only some medium and small companies, their shares are traded. Then startup companies, when they're coming with an IPO, so there it's called Innovator Growth Platform. Okay, so I am explained in my sites, so you can always read them, but it's not so important at the moment. Then SR equity shares. These are special rights equity shares, where some person like a promoter or a executive post position like a CFO, CMO, he will have more rights for every share has one voting right, equity share. एक share है तो एक voting right. But some people can be given extra voting rights. Okay, so it can be either 2:1 or it can go to 10:1 also. So if I am having one share, I'll have 10 voting rights at the maximum, or I can have two, depending upon what kind of rights have been given to me. And it can be given to only very few people and very few companies in India. Only the companies which are, IT companies or technological driven companies, or companies which are using digital technology and information, data management. So those companies where the promoters have an expertise. Okay, because if they leave, then it's going to be difficult. So they are given some extra voting rights. Now, whenever a startup company comes, so these companies raise money by various way of rounds from the public, from the private equity investors and other people. So whenever they are coming and issuing shares and bringing them on the board of the that company, so the promoters' shares get diluted. They started with 100%, it goes down to 50%, it goes to 25%. Now, any person, other person can take over the company. There is a threat if the promoter's shareholding drops to about 10%, 20%, 30%, which means any other person can take over the company. To protect such promoters of startup companies or companies which are into certain industries, so they are given special voting rights that can go up to the promoters can be given 10 shares or 10 votes for one share. Okay, but this is only for 5 years. Okay, and then it can be extended for another 5 years maximum. So maximum this can be for 10 years, special voting rights. Okay, fine. And it is only for some select few companies and not for companies like Reliance, Adani's, Ambani's. No, it is only for a certain set of people and with certain market cap. So we'll understand the market cap of less than 1,000 crores is applicable limit for such companies. Okay. Any company, if the promoter holding is zero, what is tell about it? Haji? If any company's promoter holding is zero, so what is tell about how will it look like the company? Okay, hold on. Just close it down. I'll answer this question. So there are companies which don't have any promoters also. There are companies where they don't have any promoters also. Okay, like ICICI Bank doesn't have any promoter, for example. L&T may be having no promoters. Okay, so we'll just talk about that. Okay, that's a good question. We'll discuss that. Then fast track IPO, because the whole process is very lengthy. First you have to make an offer document, file it with the SEBI, and then go for for their approval. So it takes 30 days here and there, and preparing a prospectus. So it consumes a lot of time. So there is a fast track IPO also. Some companies which are already listed on the stock exchange, or the companies which are now IPO is only when the company will get listed for the first time. Okay, fine. So there are some companies which have a very good track record in terms of legal track record. They are legally compliant companies. There is no pending case against that company. Okay, or if the company is listed and coming from an FPO, so it can be a fast track FPO also, where the company shares are traded in the stock exchange for the last 3 years. Okay, so such companies will be allowed to bypass all the process. Okay, so process means they are not required to file an offer document with SEBI. Okay, and they don't have to give any security deposit to the stock exchange. So there is something called security deposit we're going to discuss. Then we have QIBs, qualified institutional buyers. So these are 13 such institutions in India which has been classified as QIBs. They are very big, powerful institutions. They can analyze the companies and understand those companies well. So those people are called QIBs. So we are going to discuss about them a little bit more in detail, but later on. Incentive not allowed. So shareholders can't, or when the company is coming with a issue, so they can't give incentive. You apply for shares, they'll give you 3-day package to Switzerland or maybe to Shimla or someplace. So they can't announce, or then you will be get a free coupons or something. They can't do that. So it has to be without any incentive. Period of subscription, advertisement. So there is always a advertisement, pre-advertisement and post-advertisement at the time when the offer is made. So before the company comes in a offer, so they have to advertise in the newspapers. So this is our company, what it is doing. And second, after the company has closed the offer, so they tells public how much money they have received, when the shares will be getting in the demat account. Okay, some more details we can talk about. Okay, so there is some restriction. So once you are coming with a capital issue, you can't come up with another issue within a certain period of time. Okay, so we start from here, main. Okay, fine. Just read. Anand, use the microphone. So slide number आपका और मेरा डिफर करेगा ना, तो आपको करना है एप्लीकेशन ऑफ रेगुलेशंस. Applicability of the regulations. Initial public offer by an unlisted issuer. Okay, so it's an this applicability with regard to unlisted issuer. So that means so far you are not listed in the stock exchange. Only after the IPO you will get listed, isn't it? Your stock will be traded in the stock exchange. Okay. A right issue by a listed issuer, where the aggregate value of the issue is 15 rupees or more. 50 crores or more. Now, this is basically talking about applicability of regulations. So it is applicable to an IPO for an unlisted company. So the regulation is made for a new company which is going to be listed after the IPO. Second, a rights issue. When a company is coming with a rights issue, and if the value of the offer is more than 50 crores, then only these regulations will be applicable. The company is issuing shares to its existing shareholders and it's worth only 10 crores. Then this regulation is not applicable to them. It means that. Is that okay? अगर एक कंपनी 10 करोड़ का राइट इशू ला रही है, उसके लिए रेगुलेशन का कोई मतलब नहीं है. दे कैन इशू इट विदाउट. इसमें 50 करोड़ दिया हुआ राइट इशू के लिए, ये लिखा हुआ है ना. जो वो 15 करोड़ बोल रहा था 50 करोड़ से। ओके, इसको बुलाना पड़ेगा कि नहीं, वैसे भी हट जाता है ना। सो इट अप्लाइज टू एफपीओ ऑल्सो। सो आईपीओ, एफपीओ, राइट्स इशू। So this regulation is applicable to all such kind of companies which are coming with an IPO, FPO, or rights issue. A preferential issue by a listed issuer. So even the company is coming with a preferential issue, that means it's going to allot shares to only few people. Okay, so it is applicable. Okay, I am not, because there's a very long question you are asking. So कौन से शेयर्स? अथॉरिटी? अथॉरिटी कौन सी अथॉरिटी? अच्छा, अच्छा, क्या नाम आपका? शिवारे? Just hold on. Ask me the question after some time. I'll understand because I'm not able. It's going over my head. Okay, fine, no problem. Maybe a valid question, so I'm not getting it at the moment. Okay. A qualified institutional placement by a listed issuer. So a qualified institutional placement. So it can be a preferential issue. It can be a qualified institutional placement to the QIBs. Okay, all those 13, mega institutions of India, the company can issue directly to them also, or company can issue to, say, any one person or 2% or 3%. So that's called the preferential issue, and QIB placement is to only to the certain select few institutions which are registered with SEBI. An initial public offer of Indian depository receipts. Yeah. An initial public offer of Indian depository receipts. So, second was the same thing. So, either an IPO or rights issue in form of IDRs. Okay. Now, there's something called ADRs and GDRs. ये सुना आपने? So, they are issued abroad. If any foreign company is coming and issuing shares in India, not directly, but in an indirect way through IDR. Okay. So these rules are applicable to them also. So far, there is only one company in the history which has come and issued, IDRs. That is only Standard Chartered Bank. Apart from that, there is no other company which has come in India and issued. So these are very seldomly used, regulations. But we will discuss about that later. Okay. Okay. So same thing. Either it's a right issue or an IPO through a process of IDRs. Now, basically, IDR is or ADR is that you are not issuing shares directly in the country, but you are keeping some shares with a custodian and getting some receipts, and you are listing those receipts in the stock exchange, which is a bundle of, say, 5 shares or 10 shares of that company. ये पता है आपको process? Are you knowing what are ADRs, process of ADR, how they are issued? Okay, so let me just give you some idea. Suppose Reliance needs money, okay, and they require foreign exchange, and they want to raise this money from, say, New York or from London or wherever. Okay, so they can issue shares to the Americans. Okay, fine, or to the European guys, but they don't issue shares to them directly because this involves a lot of processes. There are lots of regulations and everything. Of course, recently about a month back, the SEBI has given nod for issuing shares abroad also. Okay, but it will take time to set in. So now there is a shortcut mechanism. The shortcut mechanism is Reliance. They will, keep certain shares with an American custodian there. So there is a bank there. They will keep all the shares which, worth, say, 100 crores, for example. Okay. So they carry the 100 crore shares, okay, and keep it with the custodian in America. Okay. An American bank will give a receipt that I have received 100 crore shares or, say, 1 lakh shares of Reliance, for example. Okay. They'll say that we have got it. Now, what Reliance is going to do, Reliance is going to make a bundle of 5 shares. Okay. Fine. And 5 shares, if it is 2,500 or 4 shares, it will be 10,000 rupees. Okay. And today, suppose $1 is equal to, say 100 rupees. It's about 80. So 80 rupees. So 10,000 divided by 80. How much it comes to? 125 आ जाता है. 125 4 शेयर जो होंगे कितने के हो जाएंगे? Just calculate. there's a 10,000 rupees shares, 10,000 divided by 80, 125. So each GDR, each receipt, okay, its initial price will be $125 because it represents 4 shares of Reliance. Okay, so the custodian will give receipts based on a bundle of 4 shares. Okay, now those receipts will be listed in the stock exchange at the New York Stock Exchange. So people are going to buy those receipts. Okay, public, the investors, they are going to buy those receipts. Okay, so the person who buys Reliance 1 GDR or ADR rather, so he has to pay 125 and he will become the owner of 4 shares. The 4 shares he is not directly holding, it is lying with a custodian, but he has bought a receipt which says that it is having 4 shares with a custodian. So indirectly he is holding the share of Reliance. Now that will get listed on the stock exchange. So the starting price is $125. So with every day, the price will keep changing. It may touch $200 if the share price of Reliance goes past from 2,500 to say 3,000 something. So even the ADR's price will keep changing in the market there. Okay, fine. If the ADR goes up, then the Reliance share in India will also go up because the foreigners are buying more. Okay, so there is a lot of demand of ADRs there. So it's an indirect way of having shares of Reliance in America through holding a depository receipt, which is backed by number of shares. And first time they are traded at the current exchange rate and number of shares. And then subsequently, when they get listed, so they will be trading at whatever price, depending on the demand and supply and depending on the good performance of the company, the ADRs will keep rising or keep falling as the share of Indian company of Reliance keep falling in rising. Okay. अगर Reliance का 2,500 का share, it can go to 2,000. That 125 will drop down to 100. Okay, or it may go to 150 if the Reliance share goes to 3,000. So it will keep rising or falling as Indian shares also rise and fall. But sometime it may be just the opposite because the ADRs may dictate the price of Indian share price in India. If the foreigners are buying more and more ADRs, okay, fine, and so the price of ADRs can go up also, which will reflect on a higher price. Now, when you look at in the evening when the US market early morning the closes, if Reliance ADR has gone up by say 2%, the Indian share price will also go up by 2% because there was a big demand in US for the ADRs. Okay, fine. So, and similarly, the correspondingly IDRs are issued in India by any foreign company who requires money in India in Indian rupees because they want to spend money in Indian rupees. So they can keep certain shares with the custodian, and custodian is going to issue receipts, and those receipts will get listed on Bombay Stock Exchange and National Stock Exchange, okay, at the price, and then the shares of the one company which is called Standard Chartered, their IDRs are traded in Indian Stock Exchange. Okay, that's all. Fine. So IPOs, SME, okay. So innovators growth platform, which I talked about, startups. Of course, it has not taken up so much. So will a bonus issue by an issuer. So if a company is coming with a bonus issue, also the regulations are applicable. Okay, fine. So it's applicable to IPO, FPO, rights issue, bonus issue, all sorts of things. Okay. Now we come to the main part. Okay. Initial public offer on main board. Okay. Fine. So what is main board? Read this. So basically, main board is the main board other than the SME board. SME exchange is basically for small and medium companies, and main board is for all the companies whose paid up capital is above 10 crores. And if any company is having, a paid up capital less than 10 crores, they have a choice to go to SME exchange. So now the regulations, I'll show you the regulations also. I'll share the regulations with you. So the regulation is about a big document. Okay, it's about 500 pages document, and regulation number 4 to 55 deals with IPO. Okay. Regulation number 101 to 131 deals with an IPO. Okay. I'll just show you if I can show you. Okay. So this is the document. This is the regulation. It's a very big document. Okay. Containing a lot of regulations. Okay. Uh, so can you see on the board? उसको बुला लो एक बार, तो वो सेट करेगा, कुछ प्रॉब्लम है. ओके, सो दिस इज द रेगुलेशन. ओके, so this is called, this was issued on 11th of September 2018. So this is, first section is the short title. Okay, please focus here. So first is a short title preliminary, then definitions. So it talks about definition of advertisement, anchor investor, board, book building, composite issue, which is right issue, and public issue. IPO company can come with an FPO and right issue at the same time. Okay, then it is, offer document. Okay, then it contains, a lot of definitions. Okay, fine. So then if you just exclude the definitions, so you can just go through the definitions also, because they are very important otherwise for your understanding of the regulation. So regulation number 4, isn't it, which I talked about, starts from 4. So what we did was, so applicability of the regulation. So we have done the regulation number 3. Just we finished applicability of regulations. It's applicable to IPO. Okay. Then, then we have the IPO on the main board. So we are here actually at the moment. Okay. Fine. So this is the starting point, which starts with regulation number 4. Okay. Just you can see. So हाँ, अभी अभी हम इस पे आ रहे हैं, अभी उसका नहीं है, अभी हम आगे यहाँ आ गए, ये आ गया आपको. Okay, so I'll take you to the regulations again later on. So regulation number 4 to 55 deals with IPO. Regulation number 101 to 131 deals with FPO. Now all the regulations are IPO and FPO are look like similar. Okay, fine, but there is little bit changes, because whatever is applicable for IPO is the first time, so it will have more regulations. FPO will have little less diluted regulation, but more or less it looks like the same. Okay, fine. But we'll be doing mainly between 4 to 55. So what I am talking about is with respect to an IPO. Okay, fine. No, ऊपर से entities. So first of all, those companies which are not allowed to raise money from the public. Okay, that means all other companies which are mentioned here, they are allowed to raise IPO, win IPO. Okay, first. An issuer shall not be eligible to make an initial public offer if the issuer, any of its promoters group, or directors or selling shareholders are barred from accessing the capital market by the board. Okay, now sometimes SEBI announces that these people, they cannot issue shares to the public. Like Vijay Mallya, they prohibited him to come to India and issue shares. Okay, fine. So if the issuer or any of its promoters or promoter group or directors or selling shareholders, I mean selling shareholders means those who are offering for sale. I am a big shareholder of the company and I am offloading my shares through an IPO process. So if I am debarred from the board, then I am not permitted to come with an IPO. I will not be participating in the IPO. Is that okay? Now, second is the promoters, related to promoters, the people who are very much related to the promoters. Okay, इसको पढ़ लो, एक सेकंड खड़े जाओ, इसको पढ़ लो. If any of the promoters or directors of the issuer is a promoter or director of any other company which is barred from accessing the capital market by the board. So, if any of the promoters or directors of the issuer is promoter or director of any other company and that person has been debarred, so then also, I mean, the promoters cannot come and issue the shares. हाँ, नहीं allowed नहीं है. अगर आप promoter हो, okay, of a company, and you are also associate of another company, and that company has been debarred, so the rule applies to you also. Okay, any of the promoters or directors of the issuer is a promoter or a director of any other company which is debarred from accessing the कैपिटल मार्केट. ये जो है ऑफ हो जाता है. हाँ, ये चेंज कराना पड़ेगा, ये कुछ प्रॉब्लम है इसके अंदर. ओके, अभी तो मैनेज कर रहे हैं हम. देन सपोज यू हैव बोरोड मनी फ्रॉम द बैंक एंड यू हैव नॉट पेड इट. ओके, यू हैव डिक्लेयर्ड एज अ विलफुल डिफॉल्टर. सो इन दैट केस आल्सो यू आर नॉट अलाउड इशू शेयर्स टू द पब्लिक. through an IPO process or an F. If you are a defaulter, you're taken loan like, again, coming case of Vijay Mallya, he's taken lots of loan and he's not able to pay it. So he's been declared as a default. So if you are an economic offender, declared as a fugitive economic offender under the law of that law, then also you can't. Now you have just, you are in India, you have gone to, other country and you are hiding in that country. For example, a lot of people like Lalit Modi or even, Vijay Mallya, Nirav Modi, and so a lot of people who are just sitting outside. So they have been declared as offenders. Okay. So they can't also come up with issuing shares in India. Okay. Entities.
Entities not eligible to make an issuer shall not be eligible to make an initial public offer if there are any outstanding convertible securities or any other right which would entitle any person with any option to receive equity shares of the issuer.
Now, exception is ESOP. So, if the company has issued convertible debentures, which means, those will become shares after some time. So, company cannot come with an IPO unless those convertible shares are converted into shares. So, first convert the shares, those convertible, and then come with an IPO. Because then, then will not be fair to the people who are holding convertible debentures. Okay, fine. Because first they should become the shareholders. Then you can come with an IPO. So that's the process. Except the employee stock option. If employees are given certain options, okay, and if they are not, exercise their right, it's okay. The company can come with an IPO. Okay. Okay.
Eligibility requirements for an initial public offer. An issuer shall be eligible to make an initial public offer only if it has met.
Okay. Now, most important part for all of you. Okay. You have to remember it. It's very simple also. Okay.
It has net tangible asset of at least 3 crore rupees calculated on a restated and consolidated basis in each of the preceding 3 full years of 12 months each, of which not more than 50% are held in monetary assets.
Okay. So let's talk about uh, it has a net tangible assets of at least 3 crores.
Net tangible assets
Sorry, I'm just reading, calculated and restated in each of the preceding 3 years. So that means it should have 3 crores of net tangible asset in the last 3 years, every year, not less than 3 crores in each of the year. Okay, I'm just giving you an example also. So first of all, what are net tangible assets? So net tangible asset is equal to total assets of the company minus intangible assets like copyright, patents, minus the liabilities. Okay, that's called tangible assets. So all, suppose a company has 100 crores of, plant and machinery. Okay, so we'll take that. Okay, if the company has some patents and copyright, we'll ignore that. Minus the liabilities. Suppose company has taken 20 crores of loan, so that will be minus. So company has net tangible assets of 80 crores in that case. Okay. Now the tangible assets are plant and machinery, land, vehicle, machinery, building, all such things. Okay. But then there are certain assets which are called monetary assets, like cash in bank, cash in hand, receivable from your customers. Okay. So read this. What is written?
provided that if more than 50% of the net tangible assets are held in monetary assets, the issuer has utilized or made firm commitments to utilize such excess monetary assets in its business or project.
Okay. So which means that you can have monetary assets not more than 50%. Okay. So let's take an example to understand. Suppose these are the monetary assets, first of all. Okay. Before we go to the tangible asset, bank deposits, trade receivables, cash, short-term investments. These are all monetary assets. Okay. For each of the year. For 2021, there were 4.5 crores. 2022, there was 6.5 crores. 2023, there was 7.5 crores. Okay, fine. Now, this is net tangible asset. Fixed assets, intangible assets, monetary assets, which is 4.5 crores, figure taken from here. 6.5 crores, it's coming from there. Okay, fine. Then total assets. So then if you have to calculate the tangible assets, so total assets minus intangible assets, which is 12 crores. So that means 41 minus 12, it becomes to 29.5. So these are called tangible assets. Okay. Net tangible asset, you reduce the liabilities or any loan or any payables. So net tangible is how much? 16 crores. Then 24 crores and 24.5 crores for the 2 years. Then monetary assets are, which is, the 4.5 divided by 16. So it's 28%, 27%, and 31%. Is that okay? Fine. I'll just show you an Excel sheet also, which I'll share with you. So here, just to tell you that this company is meeting the criteria because it has net tangible assets of 3 crores in every year. Okay. First year it had how much? 16 crores. Look at the last bottom before line. Okay. 16 crores, 24.5 and 24 point. It's all above 3 crores. Fine. And the monetary assets are less than 50%. Isn't it? Fine. So it is meeting the criteria. Now I'll tell you the logic also what it is says. Okay, why they are saying this. Now a company wants to come with a public issue. Suppose it doesn't have, it is not meeting the net tangible assets criteria. So promoters can bring a lot of cash and they can increase the bank balance. If the bank balance is increased, so percentage of monetary assets will go up. Okay, just to meet the criteria of an IPO, a company can always manipulate by bringing in more cash. The promoters can bring a lot of money into the company without investing in the company. They can park it in a bank and still meet the criteria. But in that case, the monetary asset percentage will go up, and that will hold the company for raising the issue from the public. So I'll just show you here. Okay, so look at this table. So this is the same thing. Okay, so the same table. Okay, fine. Can you see here? Fixed assets. Okay, intangible assets and monetary assets 28, 27, 31. And monetary assets are coming from here. Is that okay? Suppose I make a change here. Suppose I make this to 10. What will happen to the monetary assets? 46%. Suppose I make it to 20. So monetary assets become 59%. So this is not, acceptable. It should be below 51.
बेसिकली इसमें रैशनल यही है कि आपका जो बिजनेस है वो पहले से सच्ची में फंक्शन कर रहा है
हाँ,
लास्ट मूव पे अपन
आपने कोई हेराफेरी नहीं करी है और यू आर नॉट मैनिपुलेटेड द अकाउंट्स टू रेज एन पब्लिक इशू. Okay, so I'll just share this Excel sheet so you can always learn from here. Okay, fine. So coming back to the slides, and then further read.
provided further that the limit of 50% on monetary assets shall not be applicable in case the initial public offer is made entirely through an offer for sale.
Okay, so I'll come to that later. So यहाँ पर क्या था, अगर आपका 51% से ऊपर क्रॉस कर गया मॉनेटरी एसेट, then the company should have made a firm arrangement to spend that money. Where? To buy fixed assets. अगर कंपनी के पास बैंक बैलेंस बढ़ गया है, so company and the monetary assets are exceeding 50%, then they should make immediate arrangement to convert the monetary assets below 50%. To bring down the ratio of monetary asset below 50%, how can they do it? By investing into business. By buying fixed assets. अगर fixed assets में खरीदोगे तो monetary assets की अपने आप कम हो जाएगी value. Isn't it? Fine. Is that okay? For example, suppose this was the case. Suppose this was the case, 59%. Okay. So if I buy, for example, this is 32. Okay. I make it 50. Sorry. I make it 50. Okay. 32 था 50 हो गया. So that means my bank balance will go up to 8 only now. So what will happen? 26% हो गया. Isn't it? What I have done, whatever balance which is lying in bank, I have bought some assets. The moment I buy assets and expand my business, my criteria is met. Have you got it? ये समझ में आया? Suppose the company was having a huge balance, bank balance, and the monetary assets are above 50%. So what I have to do? I have to invest and buy assets. I have to buy a building, plant, machinery, equipment, okay, which will actually make my monetary assets less than 50%. And then I am eligible for a public issue. ये आया समझ में नहीं आया?
हाँ जी सर
आगे.
मतलब वही कंपनी लेकिन इसमें फिर हेराफेरी कर सकती है ना कोई अपने कोई मतलब अपने से ही अपना प्लांट या प्रॉपर्टी खरीद ली
हाँ, अब देखो ऐसा है, अब लॉ तो है, अब लॉ में किसी को भी कोई आदमी कितनी भी हेराफेरी कर ले, बट लॉ तो बनता है उसके लिए. अगर आप चोरी करोगे पकड़ जाओगे. अब चोरी करके आप दुबक के कहीं बैठ गए, 6 महीने तक अंदर ही थे बढ़ते कहीं, तो फिर क्या कर सकते हो? वी आर नॉट डिस्कसिंग दैट केसेस. वी आर सेइंग दैट देयर इज अ लॉ. You have to meet the law. Okay, if somebody is trying to do again something that is मतलब okay, is that okay? ये समझ में आ गया? So I am just showing it again. This is very important. पहला clause, कि आपके प्लीज फोकस है प्लीज. So the net tangible asset should be more than 3 crores every year in the last 3 years. And within the net tangible assets, the monetary assets should be less than 50%. Is that okay? But if your monetary assets are above 50%, then make a plan immediately to make it, bring it back to below 50%. Okay? Provided that, ye padho.
Provided that if more than 50% of the net tangible assets are held in monetary assets, the issuer has utilized or made firm commitments to utilize such excess monetary assets in business or project.
Is that okay? Is it clear? Okay. Now, this monetary assets provided for the limit of 50% is not applicable if there is an offer for sale. If IPO can be for a fresh issue or offer for sale. तो अगर कोई promoter बड़ा shareholder, if he's offloading his shares, then in that case 50% monetary asset is not applicable to such kind of an event. Only when you are raising a fresh issue and you are going to put that money back into the business of the company, then only the criteria of more than 50% is applicable. It should not be more than 50%. But in case it's an offer for sale, okay, that case the criteria is not applicable. Okay, just hold on, I'll tell you the reason later on. Okay, now second, what do you?
It has an average operating profit of at least 15 crore rupees calculated on a restated and consolidated basis during the preceding 3 years, with operating profit in each of these preceding 3 years.
Okay, so company should be profitable. It should have an average operating profit of 15 crores in the last 3 years, average. Whereas net tangible asset was that it should have net tangible assets of 3 crores every year. But the operating profit is an average. Of the last 3 years, 15 crore का profit हर साल में होना चाहिए on an average. Okay. So let's take this example. So revenue is 1680 crores. Okay. Cost of goods sold is there, profit is there, expense is there. So operating profit is the bottom. So this is a profit loss account of the company. Okay. So operating profit I'm giving at the end. Okay. Which is 22 crores, 10 crores, 12 crores, and average is 15 crores. Okay. 22 plus 10 plus 12 divided by 3. Average is coming. Though in the last 2 years, 22 and 23, it is not meeting the criteria. But on an average, it is meeting the criteria. So company is profitable. Okay. And it is meeting the criteria of having 15 crores of operating profit in every year. Is it okay? So if this criteria is met, company is allowed to go for an IPO. Is that okay?
So, just one question. Like अभी हम एग्जाम्स के पर्सपेक्टिव से पढ़ाई कर रहे हैं, तो इसमें जो केस स्टडी रहेगा यही रहेगा, और इसमें जो जो जैसे आपने एक शीट दे दोगे.
I'll be doing a case study.
Okay.
I'll be doing a case study. It will be with regard to some company. Only the company name will change and the figures will change. Okay. So you'll be able to do it. Okay. Okay.
It has a net worth of at least 1 crore rupees in each of the preceding 3 years, calculated on a restated and consolidated basis.
So first was net tangible asset. Then we come to operating profits. Third is net worth. So there are only three. Okay. So net worth should be at least 1 crore. Okay. In each of the preceding full years, 3 full years. So that means every year, the company in the last 3 preceding year, the net worth should be above 1 crore. And net worth is what? Total assets minus total liability, or shareholders fund plus the reserves and surpluses. If you have to calculate otherwise, so either take shareholders capital and reserves, which is net worth, or we take total assets minus the total liabilities, excluding the shareholder capital and reserves, we get the net worth. Is that okay? Okay. Okay. So let's look at this example, net worth. So company has fixed assets, total assets, current liabilities, borrowing, and net worth is basically 150. Okay. 175 minus 40. Okay, minus 100. So it comes to 35. Okay, fine. So 170 minus 140 हो गया ना पहले वाले केस में. So net worth is 35 crores, 25 crores, and 33 crores in the last 3 preceding years. Okay, fine. What is the net worth criteria? 3 crores and above. So this company is meeting 1 crore, sorry, 1 crore. Okay. So I'll just show you, what I have done is I put everything in like operating profit ले लिया था हमने. Okay. Fine. ये आ रहा था इसका एवरेज आया हुआ. So you can always make a change and you can play the game yourself. And net tangible assets, net worth. So again, net worth is there. So, if I change this to, for example, 100. So net worth falls to 0.67. So this is not, if this is the case, then the company is not eligible because the net worth is coming negative 6.67. Suppose I make it to say 180, then the net worth is 13 crores. It's good. Company can come up with a public issue. Is that okay? Fine. Is it clear? I'll share this Excel sheet with you just after some time so that you can just have a look.
The last 10 years का हम बोले कोई कंपनी लास्ट 10 years से है और भी आईपीओ में जा रही है तो हमें लेकिन जो डेट
पिछले 3 साल देखना है.
देखना 3 साल लगेगा.
हाँ. Okay. हाँ, for 1 crore. Yeah. Fine. So I'm just going back. So it is 2021, 22, 23. आपको 23 तक देखना है. ठीक है. मतलब अगर 23 में IPO ला रही है तो लास्ट 3 years देखना है. Is that okay? Okay. हाँ. थोड़ा बहुत और करते हैं, then we'll have a break. Okay. Just read this.
If it has changed its name within the last 1 year, at least 50% of the revenue calculated on a restated and consolidated basis for the preceding 1 full year has been earned by it from the activity indicated by its new name.
Suppose the name of the company has changed. For example, the company name was ABC Card Limited. Okay. And it has changed to ABC Scooters Limited. Now the name has changed. That means company's business has changed. So if the company has a turnover of 250 crores, look at this things on the right hand. Okay. So more than 50% should come from the new name. So ABC Scooters turnover is 150 crores and Card Limited is 100 crores. So that means 60% of the turnover is coming with a new name, isn't it? So if it has changed its name within last 1 year, 50% of the revenue calculated on restated income for the preceding full year has been earned from the activity indicated by the new name. So नए नाम से more than 50% should the revenue come from the new name, because then company has changed the name and 90% of your turnover is from the old name. Maybe you are selling cars, now you change your business. Okay. So you can't come with an IPO unless you should meet this criteria. Is that okay? It sounds logic. The company has changed the name, new company has been formed, and they are coming with an IPO. So at least they should have done some amount of turnover that should be more than 50% of the total turnover that year coming from the new name. So that's the criteria. Okay. General condition.
An issuer making an initial public offer shall ensure that it has made an application to one or more stock exchanges to seek an in-principle approval for listing of its specified securities on such stock exchanges and has chosen one of them as a designated stock exchange.
So you have to make an application to stock exchange. Okay, that we are coming with an IPO. Okay, and you have to choose one designated stock exchange, because in India we are having two: National Stock Exchange, Bombay Stock Exchange. So you have to make an application to the National Stock Exchange or Bombay Stock Exchange or both of them, and at least make one as your designated stock exchange before coming with an IPO. Okay, fine. So you get a approval from them. Fine. कि हम लोग IPO ला रहे हैं, we need your approval. So you say, okay, go ahead. We give you approval. Okay. Depending upon whether you are meeting the criteria or not. Okay.
It has entered into an agreement with a depository for dematerialization of the specified securities already issued and proposed to be issued.
Now all the shares are in demat form. Nobody can issue paper scripts. Everything has to be in demat. So it has entered into a agreement with the depository, NSDL or CDSL, that we are going to get our shares and new shares which are going to be listed in demat form. Okay.
All its specified securities held by the promoters are in dematerialized form prior to filing of the offer document.
Which means, all the shares of the promoter should be also in demat form. Okay.
All its existing partly paid up equity shares have either been fully paid up or have been fortified.
Okay, forfeited. So if it has some existing shares which are not fully paid up, fine. Suppose the company has yet to collect some money from the shareholders. For example, company has 10 shareholders. It's a company which is not listed in the stock exchange. It has certain number of shares. Okay. So some money has to be collected from the shareholders. First, they should collect that money from the shareholders, existing shareholders. Then only they're allowed to come with an IPO. Like, for example, a company like Idea Cellular, now it's called Vodafone Idea. It came in IPO in 2007. Before that, Tata's, Birlas, and AT&T, they were the shareholders of the company. And there were some more shareholders. I was also one of the shareholders. They had given some shares to comply with the Companies Act requirement. Now, if I have to pay some money, I should pay it as a shareholder. Then only the company can come with an IPO. Okay. Till then, there are only three main shareholders: Tata's, Birlas, and AT&T. And then Chutta just to make sure that there are at least 7 shareholders for a company to be called a limited company. Okay. Or if they have not given the money, then the share should be forfeited. अगर मैंने पैसा नहीं दिया, they can cancel my shares. Okay. Either have to pay or shares will be cancelled. Okay. हाँ, बस 2 चीजें और कर लेते हैं, फिर कब करते हैं, ये इंपॉर्टेंट है. एक सेकेंड, ई था, यहां तक जाएंगे हम. ओके, यहां तक जाना है हमें, उसके बाद की बात है. ओके, यहाँ आइए.
It has made firm arrangements of finance through verifiable means towards 75% of the stated means of the finance for a specific project proposed to be funded from the issue proceeds, excluding the amount to be raised through the proposed public issue or through existing identifiable internal accruals.
Now, this looks to be very difficult kind of to understand. Okay, so let me try to understand what is written, then we'll read this again. Suppose the company is coming, please focus here at the back. Idhar dekho. Everybody just focus, okay? It's very important. Suppose the project cost is 2,000 crores. Suppose company says that this is the money we are going to use, for which we are going for an IPO. And how they are going to fund it? 1,000 from the public through the public issue. 1,000 तो लोगों को शेयर इशू कर रहे हैं इस IPO के प्रोसेस से. Internal accruals, so that means they have got some 200 crores with them, okay, as reserves and surpluses. The money which company has earned but not distributed as dividend, okay. Then they are going to take loans of 800 crores also from financial institutions or banks. Now, if this is the kind of a situation, now if the company comes with a public issue, okay, and raises the money from the public, but the 800 crores loans which they are seeking from banks, they refuse to give up, then there will be a problem, because the company will not be able to use the entire 2,000 crores project. Okay, in that case, there will be an infringement of the SEBI regulations. So they say, out of 800 crores which they are going to take from the loan, at least 75% of it, which is 600 crores, they should have firm arrangements from the banks, giving a letter to the company that we are going to give you 600 crores. Okay, we have committed to give you 600 crores. Okay, so that means now the company has raised at least 75%. They have got a firm commitment from the bank. So it has made a firm arrangement of finance through verifiable means. That means a letter from the bank towards 75% of the stated means of finance for specified project proposed to be funded. Project कितने का है? 2,000 crore का. The amount to be raised through proposed public issue or through existing funded from the issue proceeds, excluding the amount to be raised from proposed public or through existing identifiable internal accruals. Okay, so apart from the public issue and the accruals, so 800 crores which the company is going to take loan, at least 600 crores they should have firm letter from the bank. If that is the thing, then the criteria is met. So this is what is written here. Just read it. एक बार पढ़ो इसको. Just read it in your mind. Just read it in your mind. This is exactly what it is written, what I have explained. झलक पढ़ लिया आपने? समझ आ गई? जो बताया था वही है ना? Okay. Excluding the 200 and 1,000 crores, it's 800 crores. Excluding the public issue, excluding the accruals, 800 crores through loans, and out of that, they have got a letter from the bank that they are going to finance this thing. Okay, is that okay? Okay, now, okay, it's the same thing. Okay, I'm just.
The amount for general corporate purposes, as mentioned in objects of the issue in the draft offer document and the offer document, shall not exceed 25% of the amount being raised by the issue.
So when the company says that we are going to spend this money, okay, where we are going to spend this money? Okay, so they say they are going to buy plant, they are going to pay off some loans. and some money they can say that we are going to spend for some general corporate purposes. That should not exceed 25%. Okay. For example, if their project cost is given as like this, plant and machinery, 1,000 crores, the project is 2,000 crores, land 500 crores, general corporate purposes 500 crores. So here, general corporate purpose should not be more than 500 crores because then it will exceed 25. यहाँ कंपनी बता नहीं है कि कहाँ लगाएंगे पैसा. एक तो बता दिया प्लांट खरीदेंगे, एक बता दिया लैंड खरीदेंगे, और दूसरा तीसरा क्या है, कुछ नहीं पता. जनरल कॉर्पोरेट पर्पस, they have not identified. Okay, they're saying that we are going to spend 500 crores for general purpose. That should not exceed 25%. If you read this, the amount for the general corporate purpose, as mentioned, the objects of the issue in the draft shall not exceed 25. इतना पैसा रेज कर रही है, उसका 25% से ऊपर नहीं होना चाहिए general corporate purpose. Is that okay? Now, let's look at the second box. Plant and machinery, land, investment purpose, एंड जनरल कॉर्पोरेट. अब कंपनी क्या करती है, थोड़ा तोड़ मोड़ के लिख दिया जनरल कॉर्पोरेट पर्पस का, तो 20-25% नीचे आ गया, बट इन्वेस्टमेंट पर्पस लिख दिया कि इन्वेस्ट करेंगे पैसा, कहां करेंगे ये भी नहीं बताया. सो न्यू अमेंडमेंट, जनरल कॉर्पोरेट पर्पस एंड अनआइडेंटिफाइड इन्वेस्टमेंट शुड नॉट बी मोर देन 35%. यानी इफ द कंपनी इज गिवन लाइक दिस, देन जनरल कॉर्पोरेट पर्पस एज वेल एज इन्वेस्टमेंट पर्पस शुड नॉट बी मोर देन 35%. तो इस केस में देखो, जो जनरल कॉर्पोरेट पर्पस है और इन्वेस्टमेंट पर्पस है, दैट इज 35%. So they are saying that we are going to invest somewhere where they have not given it. General corporate purpose, they have not given any breakup. So all these amounts cannot be more than 35%. Also, general corporate purpose should not be more than 25%, and general corporate purpose plus investment purpose should not be more than 35%. Is that okay? So they should specify each and everything while they are coming. Purpose is, if you are coming with a public issue, you should be more specific where you are going to spend the money. You can have maximum leeway up to 35%, which is both investment purpose without identifying what all you are going to buy. Company is going to say, okay, we are going to invest. We have not yet decided where we are going to invest because we are just, we are in the process of finalizing something. We don't want to disclose that. Okay. Or we are looking for the best available, technology or something. So we can just keep it as investment purpose. That is allowed, but not more than put together as 35%. Is that okay? Now, this is the last slide, which I'm going to take it from here. Okay. But this is very important. Let me cover a little bit. Okay. 1 minute का है. Now, there are many companies who are not meeting the criteria of all we have read so far, but they can still come up with an IPO. Like Zomato, Paytm, they are all loss-making companies. Okay. They were not having operating profit of more than what has been specified under the regulation, but they were still allowed to go for an IPO. So this is called alternate eligibility. So there is two routes. One is the main eligibility route, other is called the alternate eligibility route. Just read this and then we end it.
An issuer not satisfying the stipulated conditions shall be eligible to make an initial public offer only if the issue is made through the book building process and the issuer undertakes to allot at least 75% of the net offer to qualified institutional buyers and to refund the full subscription money if it fails to do so.
Okay, so that means there are two conditions. If you are not profitable, then you have to do it through the book building process, and we'll understand book building. Second, you have to give at least 75% money to the qualified institutional buyers. Okay, so let's look at, if you're doing so, then you are allowed. Okay, so what is book building process? We are going to understand after the break. And before we do that, let's understand who are the qualified institutional buyers. At least we understand them. Read this.
Qualified institutional buyers. Qualified institutional buyers are those institutional investors who are generally perceived to possess expertise and financial muscle to evaluate and invest in the capital markets.
Okay, so these are people who are big institutions. Okay, they should be at least subscribing to 75% of the public offer. Okay, अगर उन्होंने apply कर दिया, then the SEBI says, okay, you go ahead with the public issue. Okay, now who are those people? Mutual funds, venture capital funds, alternate investment funds, foreign venture capital investors, foreign portfolio investors, public financial institutions, scheduled commercial banks. Okay, then multilateral and bilateral development funds, state industrial development corporation, insurance companies, provident fund with minimum corpus of 25 crores, pension fund having minimum corpus of 25 crores, public financial institutions, and scheduled commercial banks. So these are 13 such institutions which are registered under SEBI. They need to be registered under SEBI, okay, to be qualified as QIBs. So there are 13 such institutions. Now they are given up. I mean, they can be putting money in a company, even a loss-making company, but at least they should subscribe to 75% of the share capital of the company. If that is done, then they can go ahead with the publication. Okay, fine. Rest after the break.